Globally, there's a massive $3 trillion market that operates completely in the shadows. It's called private credit, and it's basically a parallel financial system. But what's happening in Nepal? Well, this isn't some fancy new asset class. It's the modern supercharged version of an age-old practice, and it's being fueled by a mix of new technology and old-fashioned economic desperation. What's bubbling just under the surface of the formal economy? It's a systemic risk just waiting to happen.
Look, we've all seen the headlines about the failing cooperatives, right? People's deposits are frozen. It's easy to look at that and think, okay, that's the problem. But it's not. The cooperative crisis is just the visible tremor. It's the symptom. Think of it like the canary in the coal mine. It's the first big warning of a much larger, more fundamental disease festering in the uncharted territory of Nepal's private credit market. All right, so to really get a handle on the true risk, we have to go inside this shadow labyrinth. And you got to understand, this isn't just one single market. It's a really complex, multi-layered ecosystem of money that runs completely parallel to the official banking channels that the central bank keeps an eye on. It's a whole other system with its own rules, its own players, and believe me, its own huge dangers.
We can actually break this labyrinth down into three pretty distinct layers. First up, you have the oldest and deepest layer, the hyper-informal sector. Then there's the one causing all the noise right now, the most volatile layer, the quasi-formal cooperatives. And finally, the fastest growing threat, the one we really have to watch, the emerging digital market. Let's walk through each one.
Okay, layer one. This is the old school stuff, built entirely on tradition and trust, or maybe a little intimidation. We're talking about traditional liquidity credit groups, rotating savings and credit associations, or just direct loans between wealthy individuals, all sealed with a handshake. The interest rates, they're insane, often jumping past 36%. But here's the kicker. Enforcement isn't done through the courts, it's all social pressure. And because these networks are so closed off, a single default can set off a hidden chain reaction that nobody even sees coming until a major player just implodes.
Now let's talk about the second layer, the one that's all over the news. There are over 30,000 cooperatives in Nepal that were supposed to be about fostering community savings. Instead, a massive number of them have basically mutated into shadow banks. They're chasing these super high-risk speculative loans in things like real estate and auto financing, and they're funding it by offering crazy high, unsustainable interest rates to their depositors. Their governance is a black box, often riddled with fraud. And that right there, that is the epicenter of the crisis we're seeing play out today.
And that brings us to the third layer, which is maybe the most sneaky of them all. This is where tech comes in. We're talking about unregulated buy now, pay later apps, peer-to-peer lending happening on social media, and really clever corporate schemes. So a business group might take out a perfectly legal loan from a bank, then turn around and funnel that same money as a high-interest private loan to one of its own companies that couldn't get a bank loan. It's like a financial magic trick, turning regulated bank money into unregulated private credit. And this part of the shadow system, it's growing faster than any other.
So you have to ask, right? Why is this shadow market just exploding? This isn't some accident. It's the completely logical, even predictable result of very specific economic pressures. Capital is actively running away from the formal, regulated system for a reason. It's being pushed from one side and pulled from the other. And this slide really lays it out perfectly. You've got these two powerful forces working at the same time. On the demand side, the central bank has been tightening its policies, which it needed to do, but that has pushed a lot of borrowers, like real estate developers and small businesses, right out of the banks. So they're forced into the shadow market, willing to pay an eye-watering 36% interest because, hey, the alternative is their business going under. Then on the supply side, you have everyday savers who are getting zero real return on their bank deposits. They're hunting for a better yield, and that promise of 20 or 30% from the private market, well, it's pretty hard to resist. It's a perfect storm.
At its core, every credit system is built on a foundation of trust. Here in Nepal, that foundation, that bedrock, is land. It's seen as the ultimate safe asset, the thing backing up loans in both the formal and informal markets. But here's the problem. That belief is turning into a very dangerous illusion. In this shadow market, the nation's safest asset is actually becoming a massive systemic liability.
This is the one question we absolutely have to ask. Because the stability of this whole hidden multi-billion-dollar market, it all hangs on the answer. And when you pull back the curtain and look at how this collateral is really being used, the answer is a resounding no. Let me show you why. Okay, so here's the trick. Here's how the illusion works. A borrower goes to a commercial bank, gets a loan, and pledges a piece of land as collateral. That mortgage gets officially registered. Simple enough. But then they take that exact same piece of land and pledge it again to a private lender for an unregistered loan. Then they might do it a third time and a fourth. This is called rehypothecation. So now you've got multiple lenders who all think they have a solid claim on the same single asset, when in reality only the first one, the bank, has a legally enforceable claim.
So how on earth is this possible? Well, it's because the formal system has this monumental blind spot. The Credit Information Bureau, the CIB, it tracks every single formal loan. It's all in the system, but it has absolutely zero data from the private market. There is no CIB for the shadow economy, and this information vacuum, that's where the systemic risk is building up totally unseen, creating this tangled mess of overlapping claims on the same assets.
So at this point, it's really not a question of if this shadow market will face a reckoning, but how the fallout is all going to be managed. And the outlook, frankly, isn't about prevention anymore. It's about containing the damage. Let's look at the strategic forecast for what's probably coming next.
The whole thing will likely be set off by what seems like a single, isolated event. A major real estate developer goes bankrupt, or a big, well-known business house defaults on its private debts. That single event shatters trust across the entire system. Every private lender is going to panic and call in all their loans at the exact same time. The result? An immediate, system-wide liquidity freeze. Cash just stops moving. Businesses that rely on that credit will become insolvent overnight. And that contagion will inevitably spill over into the formal banking system.
And when that happens, the government will have no choice but to act. The response will probably follow a very predictable three-stage playbook. First, healthy commercial banks will be forced to merge with or acquire failing institutions, basically absorbing all those toxic assets and nationalizing private losses onto their balance sheets. Second, the central bank will inject a ton of liquidity into those commercial banks to keep the formal economy from completely seizing up. And third, born from the ashes of the crisis, we'll finally see a sweeping regulatory overhaul that brings this entire shadow ecosystem out into the light and under proper oversight. So if you're a business leader watching this, here is the most crucial takeaway for you. The stability of your own bank isn't enough anymore. The biggest threat to your company might not be your own debt or your own balance sheet. It could be the hidden private debts of your most important supplier, your biggest customer, or even your main competitor. Your biggest risk is on someone else's unwritten ledger. And that's really what you need to leave with today. This isn't some forecast of a storm that's years away. The pressure is already building inside the system right now. Stress testing your business is no longer just about surviving a banking crisis, it's about preparing for the day when all of the shadow liquidity that silently powers so much of our economy just evaporates. The crisis is already here, we just can't all feel it yet.